All right, good afternoon, everyone, and welcome to Lunch with GoalsGetter by Amova. It's hard to believe it's been almost 3 months since our fresh new look across GoalsGetter and the streamlined onboarding process for clients to accept their KiwiSaver invitations was launched. But thank you for all of your positive feedback on the changes. We're really happy with how they've rolled out and are being accepted across the board. Now, a quick reminder about our GoalsGetter SOA tool, which is available to help you document your multi-manager KiwiSaver advice. We've recently enhanced this tool so that you can now easily access GoalsGetter fund data to use in your own SOA templates, if that is your preference. So if you don't yet have access to the SOA tool and you would like to, please contact me and we'll get you set up with that very, very promptly. Another reminder about the Mapua Wealth Research reports, which are available for all diversified funds on GoalsGetter. These are there to assist your client conversations and any advice you're providing. So if you don't yet have these on file and you'd like a copy, also let me know and I can get these sent out to you. At our last Lunch with GoalsGetter webinar in October, I was really pleased to let you know that September had been our biggest month on record for advised KiwiSaver inflows. And it's even more exciting to say that as of today, with 3.5 business days still to go for November, we have surpassed that record again by quite a margin. So thank you again for your continued support of GoalsGetter. Now, it's my pleasure to host Stephen Johnston and Andrew Curtain from Milford Asset Management today, as well as Greg Fleming from Salt Funds Management. Stephen and Andrew are representing the Milford Aggressive Fund, and Greg will be representing the Salt Sustainable Growth Fund, both of which are available on GoalsGetter. Now, before I introduce our first speakers, just a quick reminder that you can ask any questions during the presentation via the Q&A feature on Zoom. You can find that at the bottom of your screen. So please just drop those in at any time, and I will pass on the questions at the end of each segment for Stephen, Andrew, or Greg to answer at the appropriate time. Now, first up, we have Stephen and Andrew from Milford. Stephen is the portfolio manager of the Milford Aggressive Fund. He has more than 20 years of investment experience across global financial markets and different asset classes, and he is joined today by Andrew Curtain, who joined Milford in 2023 as senior analyst, focusing on global equities research. So I look forward to hearing from you both today about the Milford Aggressive Fund, which launched on GoalsGetter in July this year. So I'll pass over to you both now to share your screen and take us away with the first part of the presentation. Thank you.
Okay, great. Good afternoon, everyone. It's a pleasure to be here today, and thanks for joining. So, I started at Milford in 2013 as a portfolio manager, and we launched the KiwiSaver Aggressive Fund in 2019. So it's been running for over 6 years now. And I'm joined today by Andrew Curtain. He co-manages the Global Select Fund with myself, and also covers the semiconductor space for us, and as our AI expert as well. So he's going to join us on the call today to talk a bit about AI. So the agenda today is that I'll give a sort of brief overview of the fund, touch on performance, fund positioning, and then we'll talk about recent performance, and Andrew will, talk about AI because that's the topic du jour at the moment. And then we'll sort of wrap up with, what we're thinking about in terms of the outlook. So let's get cracking about the fund. The objective of the fund is to maximize capital growth, so it invests in growth assets, so shares. The fund is actively managed and is for investors with a longer term investment horizon. So the suggested investment time frame is 10 plus years. So it's a higher risk fund, and has bigger fluctuations than the other KiwiSaver funds. So I like to think of the fund as sort of gaining access to Milford's best stock ideas in one trade. In terms of sort of the overview of the fund, it is a diversified fund with a mix of direct investments, but also investment in Milford internal funds. And it's primarily globally invested. So, we're about 80% invested globally, and the balance is in Australasian shares. I make all the decisions on the fund, but collaborate very closely with their analyst team and other PMs. And at Milford, I think it's a key strength of us. We don't operate in silos, and we're encouraged to share ideas. Our investment approach at Milford is flexible. It combines top-down macro sort of thematic analysis with bottom-up stock picking. The top-down work is led by our asset allocation team, which I'm a member of, and we incorporate macroeconomic analysis to identify and manage risks, but also identify opportunities at a sort of sector and country level as well. But we put a lot of emphasis on bottom-up stock picking. In terms of how we're going to add value over time, the goal of the fund is to generate high risk-adjusted returns, and we have a number of levers at our disposal to generate strong returns over time. I mean, I would say that the backdrop has been quite challenging over the last few years, given the concentrated market leadership and elevated valuations. And, we remain pretty disciplined on valuations and are very focused on portfolio resilience and increasing diversification in the fund to perform in a range of outcomes. In terms of the performance over the last year, you can see the names there on the screen. I mean, we've seen a big divergence in growth and value by regions in the last year. In the US, it's been all about growth stocks and AI stocks. They've really outperformed. But, somewhat surprising in Europe and UK and other regions, you've actually seen value significantly outperform growth stocks. From a top-down perspective, we really like industries that are consolidating. We like investing in oligopolies, and you can see two of the top performers over the last year have been NatWest and Bank of Ireland, and European banks are an example of where we've seen a lot of consolidation, and that's resulted in very high profitability for these banks relative to their history, and it's justified significantly higher valuations, and that's what we've seen, a re-rating of European banks over the last year. But as we stand today, that we still think the European banks offer compelling risk reward. For example, NatWest, one of our bigger contributors over the last year, it still trades on 8 times earning price to book of 1. So there's still opportunities within that space. And in terms of the detractors over the last year, I mean, it's a lot to do with what we haven't owned. A lot of we're probably a bit late to the AI trade, and we're underweight semiconductors and some of the big AI winners. And also, from a valuation perspective, we've sort of shied away from some of the really hot stocks as well. But since Andrew's been covering semis over the last year and a half, we have actually, reduced our overweight and have, and increased our weighting to semiconductors over that period. In terms of the longer-term performance, this shows performance since inception of the fund in 2019, and we are the best performing fund in the aggressive category, KiwiSaver category over that period. But recent performance has been a little bit disappointing, and that reflects sort of our underweight positioning to some of the hot stocks. In terms of how the fund's positioned now, as you can see, the slide in front of you shows our current asset allocation. We have 76% in global equities, and the balance is in Australasia. Internal fund allocation is around 80%, and we benefit from our large investment team at Milford. We've got about 40 members in the investment team, and so I delegate out the Australasian exposure to our in-house Australian team and New Zealand team, benefiting from their expertise. And in terms of our largest position, it's Global Select, which is our core global product here that's managed by Andrew and myself. And that fund is style agnostic. It invests in growth companies, but we're not averse to buying value companies as well. But we're just looking for the best risk reward outcomes around the world. But we remain very active. And then I'll just jump to our top active weights. And there's a lot of concern out there about AI bubble and valuations and some of the big tech companies within the US. And as you can see in our active weights there, there's only two of the Mag 7 and Microsoft and Amazon. And actually, we've been taking back our Microsoft position quite a bit recently. But, what I would say is that, we think this fund will perform well. And, if we do see a broadening out and market performance, which I'll come to the outlook at the end, but that's sort of our base case for the coming year. But you can see, some of the large overweights to the fund are probably not household names like SSE and National Grid. But from a risk reward perspective, we think regulated utilities in the UK offer a really compelling outlook. And who would have thought that that utilities could be, the SSE's up over 40% this year and National Grid's up 28%. And, these are regulated businesses and, they have very strong returns on capital. So they've been strong performers for us. Both companies have very aggressive investment pipelines, which adds to their regulatory asset base. And SSE recently did a fundraising to fund that growth and strengthen their balance sheet. And despite the dilution risk, the stock ended up over 17% on the day. So that was very pleasing. So I'll just jump ahead now to our investment themes. And in the interest of time, I won't go into too much detail, but you can see, we have a lot of irons in the fire, lots of different companies with different drivers. And, we're just making sure that the portfolio is adequately diversified given, the rising risk we're seeing in the markets. Right, I'll hand over to Andrew now to touch on the market performance.
Hi everyone, very happy to be here and talk to you a little bit about what's been going on in markets and sort of what a lot of people are focused on at the moment is AI and whether we're in an AI bubble. So I've got a few slides here which I'll move through over the next 5 or 10 minutes. Just quickly, a couple of charts just sort of showing the extent of the returns that have been concentrated over the last couple of years within both technology, Magnificent Seven, and the AI theme. So as you can see there, the Mag 7 is sort of done near a 200% return since the end of 2022 versus only 29% for the rest of the 493 and the S&P 500. And also returns have been pretty heavily weighted towards the United States. I sort of like this chart, just sort of comparing returns again since the start of 2023. Which is good returns across the board with 75% return in the S&P 500, but that sort of dwarfs in comparison sort of the 200% plus return in Mag 7. The purple line there is the semiconductors index, and the semiconductors which act as kind of the key beneficiaries of CapEx for AI infrastructure spend are up over 300%, and then the sort of king of them all, NVIDIA, is up 1,200% over under 3 years, which is quite phenomenal. So quite a concentration of returns in a fairly narrow part of the market. So I just wanted to touch on what has been driving, let's call it the latest stage of the AI rally. So we know the AI rally has been going for a number of years, but if we remember in April, we had both a big market sell-off as there was sort of increasing macro slowdown fears combined with the tariffs which have been rolled out across the world, and we sort of hit this period of market volatility. But we also saw the AI companies severely underperform post what was sort of a DeepSeek model release. So it's sort of a culmination of things that led to big underperformance. But since then, the semis index and the AI companies have really ripped. And so what we sort of think the main drivers of this has been, one has just been data point after data point of incredibly high demand for AI, and this is manifesting itself in higher use cases, higher screen time, or active users. So ChatGPT has risen its active users of or active monthly users from somewhere around 300 million to now 800 million year to date. And on the right hand side, Google, you can see the tokens, which is kind of a term they use for essentially the amount of words or content which is processed by AI models has risen multiple times in the last 10 months alone, as you're kind of getting exponential growth. So the underlying backdrop is improving significantly for the use case of models, and I think that's coming as models are becoming far better and far more useful than they were a couple of years ago, but also you're seeing people get a bit more familiar with the models. They're getting used as you sort of become more comfortable how to prompt and use them in your daily work or daily social lives. This has manifested or led to very, very significant increases in capex. So we're certainly in a situation which is kind of a race between the largest companies in the world to spend on AI infrastructure, as they all consider it imperative that they win and sort of are an AI leader. Capex at the moment on AI is around about $600 billion this year. It's probably growing to somewhere like $900 billion next year. We think the market is sort of expecting this to trend up to around about 1.5 trillion by the end of the decade. This is an annual number. But the bulls out there, such as Jensen Huang, the CEO of NVIDIA, he's talking about 3.5 trillion of annual capex, which certainly is not priced by the market. So phenomenal levels of spend. OpenAI leading the charge and signed 1.4 trillion in commitments to either buy or rent AI accelerators over the next sort of 5 years or so. So phenomenal levels of spend, which has really been driving companies like NVIDIA, Broadcom, TSMC, and the semiconductor companies higher. But having said that, as we're all familiar over the last sort of couple of weeks, there's been a big, let's say, uplift in investor concern or skepticism on the level of AI that has been or the level of spend on AI. And if we just sort of use some round numbers here, we sort of think by the end of 2030, you need around about $2.5 trillion of underlying AI revenues to support the level of capex that's been spent to date. Our estimates is you've probably got somewhere between $60 to $80 billion of revenues. And when we talk about this, we're talking about revenues from the underlying AI services. We're not talking about NVIDIA's $200 billion of revenues. NVIDIA is selling a chip, and that is used to build the infrastructure AI, but it's not selling the end AI product. And I sort of use the analogy of, let's look at, say, the railway build out. And the railway build out, you obviously have the companies that were laying the tracks and building the trains, then kind of building the infrastructure. That's not really the revenue from the train. The revenue is selling the tickets at the end. And at the moment, I guess we can sort of maybe picture in a situation where NVIDIAs of the world are benefiting a lot from the laying of the railway tracks, but at the moment the train's not really there, running very fast, and so not many people are buying tickets to the train because it's not quite good enough, or not quite fast enough, and you're better to jump on the horse or the cart and just and get to where you want to get to that way. But having said that, it is improving, and we know all technology cycles sort of play out over a long time frame. So the sort of investment needs to be spent up front, but the benefits come down the line. There's been growing fears about the financing of this capex. We're seeing credit spreads blow out on certain companies like Oracle and some of the smaller neo clouds that are trying to finance huge amounts of capex. And of course, there's sort of the constant backline fears of like, when does AI start to get to a point where it really does produce these revenues? And I've got a couple of charts there, which is OpenAI's forecast revenue growth, where they sort of see themselves heading to 200 billion, but today they're probably sitting somewhere between 13 and 20 billion. So they certainly have a very long way to go to achieve what are quite lofty expectations in the market. Difficult question. Do we call peak AI optimism? And this is a debate we have internally at Milford all the time, and various people in the teams that have views at sort of various ends of the spectrum, and we try to sort of have constructive debate about, is this the bubble? Is it popping? How long can this run for? And I'm not here to make a conclusion of, is this a bubble and is it popping right now? But I just want to give you a couple pieces to think about. One is, if you go back through all technological cycles, you do tend to see, or you do pretty much always see tech cycles happen when the underlying conditions are present to allow that bubble to develop. And what I mean by that is a strong economy, low interest rates, and then you have investors sort of believe in the potential of the technology. And because the economy is relatively robust and money is relatively cheap, there's available to spend in this technology. And I think if you look at what's happening at the moment, we can sort of fairly safely say all those conditions are present. Always the macro is having its ups and downs, but we ultimately are have been in a rate cutting cycle in the US, and we are what we believe is an accelerating economy, which is supported by fiscal stimulus in the US. So it's sort of creating the underlying backdrop to continue to fuel this sort of technological cycle. However, and particularly becoming more pronounced in the last few weeks, the market skepticism is finally getting to a point you are starting to see some companies sell off of further increased spend. And we saw this start to happen with Oracle, who announced sort of massive upgrades to revenues, but coming with that huge upgrades to capital expenditure. And that share price has come back around about 40%. I think Friday last week was the first example where we saw a semiconductor company such as NVIDIA absolutely smash market expectation in terms of revenue and demand and upgrades to numbers, yet the stock got sold off quite violently the next day. And so it's a clear example that the market is now starting to send the warning sign to these companies that we're not quite convinced on the returns. The returns on this investment are there, and we're starting to kind of reward companies for being a little bit more prudent in their spend and starting to hurt companies that have been maybe a little bit excessive. So I think the debate's firmly on. I think, I'm not sort of willing to make a call right now whether this is sort of the peak or not the peak, but I think it feels like we're moving into a period now which is going to be more heavily debated to risks versus rewards than we're seeing over the last couple of years. So that does really sort of encourage that it's been pretty agile, been not too dogmatic in your views, been willing to diversify your exposures across a number of AI companies. And we think we're pretty well spread at the moment across semiconductor companies, cloud companies. The latest company that's getting all the attention is Google, which plays in every part. It produces its own chips called TPUs. It sells cloud capacity via its Google Cloud business. It also has an LLM model called Gemini, and it also uses AI to improve its advertising. So if you look at one company that sort of does it all at the moment, it's Google. But you've got to remember 6 months ago, Google was considered the company that was going to be most disrupted by AI, and it was being really hurt by the market. So things move extremely quickly. So we're sort of trying to take an approach to be pretty adapt pretty well here, not be too sort of not try to think we can predict exactly which winner there is, but make sure we have a blend of companies which we hope over time will allow us to sort of partake in this trade, but also manage risk. So I'm going to hand it back to Stephen quickly. He's got a few thoughts on market outlook.
Yeah, so just quickly, we're wrapping up the third quarter earnings season in the US, and just wanted to highlight, despite pretty mixed economic backdrop, there's still a number of economic headwinds out there, whether it be trade policy or higher inflation, etc. But if we look at third quarter earnings in the US and globally, I mean, it's the fastest earnings growth we've seen in 4 years, which is quite remarkable. And the beat rate, so that's beating analyst forecasts, has been exceptionally high, as I show there on slide 24. And we've also seen earnings estimates increase for 2026. And just on the bottom left there, you can see a table which shows estimates for the Mag 7, so that on the left side, and then right what's they actually delivered. So, going into the third quarter, earnings for Google were expected to be up like 5%. It was up 30%. So, I mean, some of this Mag 7 performance that we've seen is justified. We've seen very strong top line and earnings growth from those companies. But looking ahead, the chart on the bottom right there, we see that if we look at the S&P 500, the 500 largest companies in the US, the Mag 7 earnings converge with the rest of the market in 2026, and we think that'll be the catalyst for some of these sectors that have been left behind to catch up. So that's what we're sort of positioning the portfolio for a rotation in 2026. So I won't talk too much on the economic outlook, but just finishing up on the market outlook. So overall, I mean, look, it's not without risk out there, but we still think the backdrop's quite constructive for stock picking for our team. We think economic growth will be resilient because of policy support. So particularly in the US, we've got stimulus hitting the economy in the first half of 2026 from the one big beautiful bill of Trump, and we think that that'll boost consumption, which is 70% of the economy in the US in the first half. And as Andrew mentioned, we expect AI infrastructure spending to continue in 2026, and that seems well underpinned. So we think that economic growth should be okay in the US in 2026, and that should be good for earnings growth as well. In terms of the risks, Andrew highlighted the AI bubble risk. Inflation hasn't gone away, could come back, and trade tension could flare up again at any time. But the key point I'd like to make is we do expect a broadening out of that market performance, whether by region or by sector, and we think there's still decent pockets of value out there, for example, in US healthcare, European financials, etc. In terms of the aggressive fund strategy, as Andrew said, we're being patient, we're being opportunistic, we are maintaining our valuation discipline, but we think there's plenty of long-term themes and trends out there that we can tap into. And in terms of our portfolio construction, we're maintaining a balanced portfolio. We think diversification is critical here, but we'll be opportunistic and take advantage of sell-offs to buy great companies at good prices. But we're just about up on time, so I'll finish there.
Fantastic. Thank you very much, Stephen and Andrew. A great presentation and lots of food for thought for the attendees to take away today and into their meetings for the month ahead. Now, we didn't have any questions come through so far, so just a reminder to those on the call, great attendance today, so thank you all for coming along. If you do have any questions for Andrew or Stephen, please drop them into the Q&A feature and we can get those answered for you. But now, while Greg gets his screen up online, we've got a question come through just in time. So Stephen or Andrew, can you give us a quick update on Milford's current cash holding, please?
It's meaning for the aggressive fund?
Correct.
Okay, it's about 2% at the moment.
Okay. Very good. Thank you very much. And I'm now going to pass over to Greg Fleming from SALT. So while Greg is sharing his screen, I'll do a quick introduction. And thank you again, Andrew and Stephen, for your presentation. Now, Greg joined SALT in 2021, where he oversees the Sustainable Income Fund and Sustainable Growth Funds. And with over 20 years of investment experience, Greg brings a deep expertise from senior roles in global research and strategy across both New Zealand and Switzerland. So looking forward to hearing your updates today, Greg, and over to you.
Thanks, George. That's great. I should just say at the start, we've changed the name of our multi-sector or diversified funds in July. For the first almost 4 years of their existence, they were sustainable growth and sustainable income. They've now changed to capital growth and SALT income. It's not because we're stepping away from a sort of sustainability focus. It's more that some of the component funds from external managers that we have are European. The criteria for claiming sustainability under the EU taxonomies has got tighter and tighter. And so those underlying funds changed their names. We thought to align with that we should change ours here. So today I'm going to talk about what used to be the Sustainable Growth Fund, but is now the Capital Growth Fund. As George said, I started out at Salt in 2021, and we moved into diversified funds for the first time. We wanted to build two different kinds of diversified fund because we believe that investors ultimately either want growth or they want income. And the growth fund here was built particularly to address structural challenges that we saw developing over the decade ahead. A lot of those relate to particularly fiscal problems that have subsequently become more forefront of mind for investors around the world. Back in 2021, people were not speaking so much about these unsustainable deficits and debt levels. That has become more of the theme. So I just made a wee Christmas joke in there about we're doing it without RSI, repetitive strain injury, that can be included. Performing the same motion repeatedly, like having to buy the dip, as is the retail meme craze trend at the moment, or just maintaining awkward postures for long periods, which is another way of talking about momentum trades. With this fund, we aim not to cause those kind of stresses. The big themes that we have looked at are, as George said, we've got several papers on this on our website, but sustainability is clearly key. Even with the current US regime, there's still a great deal of demand for sustainable assets. New Zealand not bucking the global trend, but certainly seeing substantial inflows to ESG or sustainable themed product over the last year at a time when many US states are actually trying to get away from that message. We are a little bit more realistic that climate change is a reality and decarbonization is an important part of the portfolio. So the global shares component of our capital growth fund has really quite strict sustainability criteria. It has a carbon footprint 77% lower than the MSCI World Index. It excludes a wide range of socially and environmentally unacceptable security types, and we are prepared to hold to that philosophy. Bigger picture themes also are relating to aging global populations, low productivity. AI was touched on quite extensively by Stephen and Andrew. It is potentially a way of getting around the productivity problems we have in developed markets at the moment, but we still have to kind of, see the pudding rather than just hear the smell from the kitchen. Geopolitical tensions every day, everywhere. There's not only Russia, Ukraine, there's the whole thing about China, Taiwan, which has huge implications for chips and for AI and for global supply chains in that absolutely critical industrial area. Globalization tariffs, that's another part of it. And of course, inequality means greater demand for fiscal redistribution and resistance to that from some parties, a demand for it from other parties. So it's not been a quiet decade, and it won't be one in the decade to come. We then looked at what you'd need to bear in mind when you're developing a diversified capital growth portfolio. We said that the characteristics of the next decades are likely to be the following. First of all, lower trend growth generally. And this is what we have in fact seen. We've seen a sort of a downtrend. Exceptions occasionally from stimulus bursts, but in general, if you look at the US cycle indicator there on the right, which is up to date to this month, you see this gradual bleed downwards into downturn. No one's expecting more than a maximum 2% growth rate in the US this and next year. It could be revised lower. And you're getting a very much a bifurcated economy there, but it's not the only place in the world where economy is bifurcating into one growthy bit and one rather sluggish bit. It's actually familiar to New Zealand investors as well. At times you get hot industry sectors, and Stephen actually alluded to that, and they can offset the rather soggy underlying economic picture. Very much true in the US presently. They can create very big rallies. How long-term those gains are and how sustainable they are remains to be seen. You have to be exposed to them, but you don't want to be overexposed or reliant on them. Next point being that these cycles in the markets are getting shorter. You probably have been aware we get these short cycles. There's a risk of some relapsing in inflation, which might keep interest rates higher than they would otherwise be. There's a downward pressure on real returns, and the bulk of returns can get concentrated into quite short periods of time. Interest rates are a little more stable now, but they're at a higher nominal yield level, and in a way that can create higher expected returns expectations among clients because they see higher risk-free rates cited than might have been the case before when they were tempted into growth or risk asset classes. So the hurdle rate for taking people out of more conservative or moderate portfolio profiles into growthier profiles is higher. There's, of course, obviously a lot less leverage because of the availability of debt being constrained, but leverage has moved into a different space. It's moved often into daily leverage in, say, zero days to expiry options contracts or crypto leverage via quite opaque crypto trading sites, all those kind of things. So it's not the old style of leveraged growth investment that had in the past been a way of generating outsized returns. The central banks are not willing to overstimulate economies or launch major rescue missions because they know what happened after the COVID and the inflationary consequences. Finally, fiscal challenges, treasury bond market, credit rating, FX market implications, all of those things. And there's a great demand for consistent asset price appreciation. Growth funds tend to need to reinvest their distributions to reach their total return objective. So how do you get your returns out if you're a growth fund investor with a reasonably short-term cash flow requirement? In New Zealand, though, I'm going on to this slide, just an FMA slide here. I won't linger on it, but it's just to show nothing has been growing like the growth KiwiSaver class or the growth funds class. It has absolutely shot up over the last 3 or 4 years. It was 10% of the market in this volatility category 5 in 2021. It's now more than 40%. I think if you updated that for this year to the end of this year, it could well be approaching 45%. Meantime, more moderate funds are diminishing in attractiveness. There's a variety of reasons for that. It's partly asset value growth due to those really strong international equities years that we've had, 23 and 24 and part of 25. It's also because there's some switching of risk profiles going on among investors. You can see there's an element of chasing returns. There's an element of people responding to marketing. Growth sounds very attractive. It's impressive that some funds that are actually aggressive rather than growth openly disclose they are aggressive profiles. Not all of them do. So if we go just very quickly again into this FMA stuff, it's quite interesting, and I'd highlight that July paper that came out because I won't dwell on it, but go online and have a look on the FMA website. It shows the increasing risk profile of KiwiSaver funds over the 3 years to 24, and that will be equally true today. There's been quite a switching that's gone on, and it's a dramatic change from, as I say, a minor exposure to those higher volatility funds to a dominant exposure to those higher volatility funds. If we go on now just to look at future trends, and this is what our fund is built to basically invest on the basis of. We have major global structural fiscal problems. You'll be well aware England is a very prominent current example, but the US situation is always in the news. We just had a shutdown over partially fiscal issues. We may see another shutdown in January based on the current congressional wrangling. Lots of hard choices. Then we have a variegation between countries that are actually still prudent, and there are relatively few of them left. And they tend to have experienced quite strong currencies. Switzerland is the obvious example. The Swiss franc has just been an extraordinarily powerful currency in the last couple of years. If you had unhedged equities that are Swiss franc denominated, you would have benefited enormously through that, almost regardless of the underlying business dynamics for those firms, whether they be in pharmaceuticals, healthcare, or consumer staples, both of which are prominent parts of the Swiss equity market. But, meantime, as this is all going on, those are the respectable old structured industries that people understand. There's been ever more attention paid to accelerator securities, so-called get-rich-quick securities or techniques. most asset managers don't chase those, but there's always a pressure to dance while the music's playing, to quote Chuck Prince just before the GFC. Some strategies are probably going to be punished when there is a turn in the cycle, but at the moment, a growth manager has to defend why he's not chasing those kind of strategies. If we go to what's actually happening in the US, growth is not assured. The Trump set of policies that have been unleashed in the 12 months since the election are basically growth neutral overall. If you look up the different components that might drive growth. Yes, there's some deregulation and tax cuts, but that's very staggered. There are other things that are more growth negative, the crackdown on immigration, the tariff effect, and general uncertainty as well. So our positioning is a little bit like the positioning that Milford talked into. We're a little bit more cautious than we were 18 months ago. We think that we've got more interest in New Zealand stocks, which are undervalued and are in a better point of the cycle than in chasing some of the mega cap stocks that have led the last 3 or 4 years global asset price returns. We've also got an easing cycle ahead of us. One more reduction in the New Zealand OCR will then have its lagged effects in 2026, gradually building up some support for our domestic market. Trump risks do remain significant. Deregulation, yes, but tariffs and immigration are negatives. And of course, the pressure on the Fed, the change of leadership in the Fed from May next year, the split of the Fed Governing Council in terms of those who want to ease aggressively now and those who are moving more in terms of the established playbook. These are all issues that are overshadowing market confidence. At times, the market can blithely say it will be fine. At other times, it gets rather spooked. Consumer confidence in the US is actually very low at the moment, which is part of this kind of bifurcated market. It's very close on the University of Michigan survey to record low levels, and yet the technological AI narrative is dominating. So retail as a S&P sector has lagged the index by about 12% so far year to date. The retail consumer is feeling quite thrifty and not wanting to go out of their way to go and spend money, and yet the assumption is they'll be spending it online and using payable online services. So it's a really tricky cycle to read. At the same time, we're at all-time record valuations for many markets. Best case scenarios are priced in across the board, particularly in the US, as everyone knows, but also Europe. Europe has had a 30% year-to-date gain in the Euro Stoxx index, even ahead of the Nasdaq. From an undervalued level, but there isn't much undervaluation on traditional metrics available in the broad global equity markets at present. Bear case is that all these expectations are not met, that actually the conversion of AI technological investment into profits, into billable quarterly revenues, doesn't happen just yet, that it's maybe 2 or 3 years away, and the market will then back away from that. At the moment, the narrative's holding, but it's fragile. Bull case is that there is a sudden transformation, productivity takes a leap, and the valuation's justified by profitability. If we look at the inflation picture, though, we're not really seeing that return to the target bands, and this is affecting the pricing of those growth securities that are sensitive to the discount rate. As your discounting revenues over many years ahead with many growth companies, you need to have a good discount rate, and if the policy rates around the world are not going to come down because inflation is high, you have again a higher bar to prove you're achieving value in investing in some of those companies. Not much sort of clever thinking from governments on how to address this. CPI seems to be stuck at a somewhat higher level, and a lot of charges are just are really going to underpin that. There's disinflation from globalization is a thing of the past now. So disinflation from recessionary conditions would not be good for equities either. And steepening yield curves argues against building up too many sovereign global bond holdings. We've seen that. We've seen more pricing of term risk or long-term duration risk into the global bond markets over the last year, and that has held the total return from bond indices low. So unless you, as in this fund, you're very concentrated in your selection of global bonds, you can be exposed to a sovereign, highly indebted, dominated set of index holdings that don't necessarily diversify your global equities holdings. So the relationship between bonds and equities is also a challenge within growth fund design and management presently. Policy rates, they are, coming over the hump, but they're not going to go back down to that exceptional period that we had between 2008 and 2019. Rather, they will return to the old normal range, and people will have to start dusting off playbooks from how you price risk-free and risky assets under that more moderate range of policy interest rates between perhaps 1.5% and 4.5% that you saw previously. Priced in now, in many markets, probably easing cycles are largely done with, the exception being the US, which has been holding off for all those special factor reasons, and the UK, where there is some scope for some easing, particularly if the fiscal situation is kept under better control than the Rachel Reeves budget seems to indicate that it will be. Bank of Japan, on the other hand, is likely to tighten, making Japanese domestic assets more attractive to Japanese savers and Japanese institutions. That creates a potential drain back from the yielding assets across the Pacific and the US and elsewhere, where the carry trading Japanese institutions have been investing for the best part of 20 years. So that is something that underlies risk. Japan's kind of went off people's radar as an equity market, but as a source of funding for carry trades, it's very important. And if the BOJ continues on an upward path for their policy rate, there may be some capital heading back to Japan that can underpin volatility in Western growth markets. Finally, in terms of tariff pass-through, that is a risk at the moment. Tariff rates are obviously higher than they have been since the 1930s. The interesting thing on the right-hand chart there, though, is that a lot of firms are now reporting in surveys that they may have just increased prices a bit, but there's a lot more to come. They expect to increase prices further. So it's not that the tariff thing was necessarily overblown. It's a sequencing thing. Many firms have absorbed the cost or switched suppliers or done various things to get around the impact of imposts. That may not be possible into 2026. So watch out for sticky inflation pass through from tariffs in the US. So finally, to sum up, what did we do in our growth fund to reflect these themes? We built a slightly new type. We have more of an interest in listed real assets than the typical New Zealand growth fund. We're unapologetic about that. We still believe equities are very important, and global equities have clearly been the star of the last 3-4 years, and even over 10 years, their annualized returns in the low teens are much higher than the historical experience. So you would have been punished not to be a holder of broad global equities. However, we think that looking forward, that the real assets are probably better valued, and that they have better thematic and structural theme support. We don't think that you can just sort of chase the demand of investors to have double-digit returns every single year by bumping up blindly a global equities component of a growth fund, because not all equities are alike. We like the capital appreciation scope in the listed real asset classes of listed infrastructure and global listed real estate. And we set our benchmark very high within our growth fund at 10% SAAs for both of those asset classes. That's supported by research that we have from our global investment partner for real assets, Cohen & Steers, one of the most prominent in the world, who are looking forward with substantially higher expected returns from the listed real asset classes. In some cases, even equal to or higher than global equities. Now, if we look at our relationship to our peer group in New Zealand, and it's not really strictly a peer group because of the special features of the Capital Growth Fund that I've outlaid, but the main difference is we have a much lower broad global equities SAA weighting at 35%. The peer average in New Zealand is a little over 50%. And we park that excess global equity allocation into global listed infrastructure, global listed property. Those are not represented much in the benchmark. You see it adds just up to about 5% in the MSCI world, as you can see it there on the left-hand side. So it's clearly it's an explicit preference. It's not even a tilt. It's a structural explicit preference. We're going away from the MSCI world in its passive form and saying, looking forward, we think the listed real assets have considerably unexplored potential that we would see outperforming. So they're anti-concentration characteristics. They're very good diversifiers. I won't go into the details there. What it means is that this fund's performance is not closely aligned to growth funds in the New Zealand marketplace quarter to quarter, but it is a structurally sound alternative model. At times when you have a bit of fear or reconsideration of certain narratives, like the first quarter of this year, this fund can do extremely well within its peer group. At other times, when you have an acceptance of a different point of view that perhaps, say, Trumpism works in some form, or AI will completely transform the world, then you can get a lag out of this fund because those listed real assets aren't immediately exposed. But there was one exception, which is infrastructure, and I'll jump onto that now because, in the interest of time, I wanted to show that infrastructure in its listed form is greatly overlooked in the last 2 years. I think New Zealanders are becoming more aware of the merits of global listed infrastructure allocations within a strategic benchmark. We see a substantial benefit in avoiding downside capture from weak market periods. Not only that, but it is exposed to the transformational theme of AI investment, particularly with electricity demand, but also with the building of capacity, downstream capacity for all other forms of demographic shifts that are happening. It's a wonderfully diverse asset class, global listed infrastructure, ranging from toll roads right through to data centers, through to generators. Many different types of assets are incorporated there and can be actively allocated among. And it has been a kind of a stealth outperforming sector at times, and we expect that to continue. Its returns have not been seriously below those long-run returns from global equities. You can see that they're 7.2% annually as opposed to 7.6%. Recently, when global equities returns have been well over 10% per annum on average, you see infrastructure has at times lagged, other times it's matched. But if you look at it in the terms of a growth fund investors' time horizon, infrastructure has more defensive characteristics, and it plays the role of a global bond exposure, but with exposure to growth narratives and to demographic change. We think those secular themes are dominant, and there's just some there, the digital transformation of economies that have been alluded to, but also evolving global supply chains. Marine ports are part of infrastructure, for example, as are airports, as are freight railways, all very positive sectors. And the power and decarbonisation story needs no introduction. Also, the high adaptability infrastructure has to changing new technological demand. And finally here, if you look at why it's a valuable thing in a growth portfolio to have a decent allocation to infrastructure, you can see what's happened over the last 2.5 years, where the hyperscaler broad AI has, of course, obviously a global equity exposure that's gone absolutely through the roof with around a tripling of value, but data centers and electrical securities that are allied to that story have done almost as well without being quite as reliant on more PE multiple expansion. We don't see the same degree at any degree of PE multiple expansion in data center related infrastructure stocks as we've seen elsewhere in the market. Power is allied as well. Some data centers have their own power provision, and they may or may not be listed or available for investment, but others have grid exposures that are very important. And Yes, that's kind of where we are. We're currently positioned. I'll nip back just to show where we are currently positioned. We do have a slight underweight now to global equities in the portfolio. We are concerned that there's a lot of optimism built into the current narrative, but we are overweight commensurately in global listed real estate, which we think is at the best discount that we've seen for some time. We're neutral on global listed infrastructure, and our most recent portfolio change in the Capital Growth Fund was to move overweight in New Zealand equities by 2%, just in anticipation of that upturn in the earnings cycle into 2026. That's really my slide set, so I will be happy to pass back to George.
Fantastic. Thank you, Greg. Great presentation as always. So a couple of questions came through. One, I think you've already answered quite nicely. So it's just around the biggest growth opportunities for the next 5 to 10 years. But if you want to elaborate on that, feel free. And the other one is around what's the biggest drawdown you've ever experienced with the fund, and how did the recovery look? If you want to shed any light on that.
Okay, to do the first one first, I mean, 2022 was difficult for all equities. The fund was only slightly more resilient. I think the drawdown was in the order of about 12% in the worst time and through to September 2022. And peer group was also around 13%, I believe. It's a little difficult to make peer for peer comparisons, but when there is unanticipated inflation or unanticipated tightening, you can see the listed real assets get hurt alongside global equities. That's not the environment we're in at the moment, and so you've seen a rapid rebound as the easing has come through. I think the downside participation is lower. And if you go on, say, the Morningstar site and look at the downside participation of this fund compared to the peer group or the category average for New Zealand, it is a couple of percent lower over the 3-year period that we've been monitoring that. So they're looking at a 3-year block, but it does include 2022 still for a few more months. The biggest growth opportunity, I think, we do still favor listed real assets, but we also have quite an affinity to non-sovereign global bond instruments, and that's the other part of this fund. It only has a 15% SAA, but if you, as long as you're flexible and you don't go too far out in duration, and you look at supranational bonds, you look at green bonds, or sustainability-linked securities. You look at special project-linked securities. Those are an opportunity because bonds have kind of been overshadowed in recent years by concern about debt levels. But an agile global active bond manager can still yield a couple of percent above the domestic risk-free rate.
Fantastic. Thank you very much, Greg. And we're right on time, so I think there's no more questions come through, so I think we'll call it there. So thank you once again to Andrew and Stephen from Milford and Greg from Salt for your great presentations today. And thank you to all of you online for attending this Lunch with GoalsGetter, which was the last webinar for the year from GoalsGetter. So I look forward to connecting with you all in the new year and rolling out our next iteration of Lunch with GoalsGetter webinars. So keep an eye out for those updates from us. Otherwise, have a great rest of the year and a well-deserved break. See you all later.